Do you know how to interpret the 52-week data and find useful information for you trading? In this video, we will do exactly that. We will examine what 52-week highs and lows are, what is meant by the 52-week range, and finally, we will look at two possible scenarios with 52-week data where we can look to initiate a trade. So, let's begin. The 52-week high or low is the highest and lowest price at which a stock or a security has traded during the time period of 1 year. Typically, the 52-week high represents a resistance level, while the 52-week low is a support level. Suppose that Tata Motors trades at a peak of 530 rupees and a low of 280 rupees in a year. Then, its 52-week high price is 530 rupees and 52-week low is 280 rupees. Typically, 530 is considered a resistance level, while 280 is considered a support level. The 52-week range is the difference between the highest price and the lowest price an asset has traded over the last 52 weeks or 1 year. So it is also called the yearly range. Technical analysts compares a stock's current trading price and its recent trend to its 52-week range to get a broad sense of how the stock is performing relative to the past 12 months. Suppose that, over the last year, a stock has traded as high as 100 rupees and as low as 50 rupees and is currently trading at 60 rupees. This means the stock is trading 40% below its 52-week high and 20% above its 52-week low. These calculations take the difference between the current market price and the high or low price over the past 12 months and then convert them to percentages. One way that the 52-week high or low is used is to help determine an entry or exit point for a given stock. For example, stock traders may look to buy a stock when the price exceeds its 52-week high, or they may sell when the price falls below its 52-week low. The logic behind this strategy is that if a price breaks out from its 52-week range, either above or below that range, that acts as supports or resistances, then there must be some factor that generated enough momentum to continue the price movement in the same direction. The other way to use this data is to look for reversals. A stock that reaches a 52-week high intraday, but closes negative on the same day, may have topped out. This means that its price may not go much higher in the near term. This can be determined if it forms bearish reversal candlesticks in a daily time frame, like a shooting star, which occurs when a security trades significantly higher than its opening, but declines later in the day to close either below or near its opening price. Even though a 52-week high represents bullish sentiment in the market, there are usually plenty of investors who are prepared to give up some further price appreciation in order to lock in some or all of their profits. Therefore, stocks making new 52-week highs are often the most susceptible to profit taking, resulting in pullbacks and trend reversals. Similarly, when a stock makes a new 52-week low intraday, but fails to register a new low, it may be a sign of a bottom. This can be determined if it forms bullish reversal candlesticks in a daily time frame, like a hammer candlestick, which occurs when a security trades significantly lower than its opening, but rallies later in the day to close either above or near its opening price. This can trigger short sellers to start buying to cover their positions. You can also make use of technical indicators to confirm your trades. If you find this video useful, please drop in a like and do not forget to subscribe to the channel.